Alright everyone, what's up? It's CZ here, and I'm super excited to break down a strategy I absolutely love, range trading. And this is all about turning the crazy market into a simple box so you can play it in. And if you're new, don't worry, you'll keep it super easy. By the end, you will know how to spot ranges on any chart and trade them like a pro. There's a ton to learn, and it gets awesome. So range trading. It's like a green bull and a red bear facing off over a chart. This is where buyers and sellers are stuck in a sideways fight, and price bounces between levels instead of trending up or down. It happens about 70% of the time, giving you tons of chances to trade. Keep watching to understand why it's my favorite way to play the market. Alright, quick disclaimer, I gotta cover this. Nothing here is telling you to buy or sell, it's just for learning and not financial advice. Trading can cost you money, so trade at your own risk. Now, let's move on to the good stuff. So, what is a range? In general, a range has a range high, a range mid, and a range low. A range is when price moves sideways, bouncing like a ball between those lines. The high is where sellers step in to push it down, and the low is where buyers lift it up. The mid range, it splits it. Above, it feels bullish, and below, bearish. This happens because the market takes a break after big moves, giving you clear spots to trade. So for example right here, we see a sharp move down, turning into sideways action. And then ranges pop up after a fast move called an impulse, like a big pump or dump, because the markets need to chill and reset. After a drop, buyers jump in, making that flat wiggle. Stick around to see how it really works. To identify a range, I have a list for a few ways to spot it. So right after the impulse, when the first lower high before a bounce gets swept, or if not, when the next high or low after a bounce or rejection gets swept. Swept means price breaks a level quick and then flips back, and it's tied to liquidity as well, and we will cover it soon. This helps you find the real boundaries, so don't skip ahead, we have got examples coming. So right after an impulse, for a down move, the first low after the drop is the range low, and the first high after the bounce is the range high. For an up move, the first high after the pump is the range high, and the first low after the rejection is your range low. This happens because the first swing shows where the action shifts, buyers or sellers take over. Try it on all charts to get a hang of it. So with a down move example, after an impulse move down, the first low after the drops set the range low. Then the bounce hit the first high, making that the range high. The chart shows the mid for at 0.5. This works because the low is where sellers slow down and the high is where the bounce meets pushback from sellers. Price often tests these levels, so it's a solid start. So the up move flip. After an impulse move up, the first high after the pump is the range high, and the first low after it rejects down is the range low. Chart shows this pattern. This happens because the high is where buying peaks and the low is where sellers start pushing back. Look for red candles at the high to catch that shift. It's great practice. So for example, right here, impulse move down. The first low after the down move is your range low. The first high after the up move is your range high. But the range high got swept. So the previous key swing high is still your range high. Now for example, right here, you have the impulse move up. The first high after the up move is your range high. First low is the range low. But the range low got swept. Previous key swing low is still your range low. Now for example, right here, for an up move, the first high after the pump is your range high. The first low after the rejection is your range low. And here it got swept again. The previous range low is still your range low. Now let's talk about the played out range. The played out range, I got an example right here. So the high got swept is your range high. Low got swept is your range low. Sweep of the previous high, so the high already got swept. And now the low also got swept. I call this the played out range, because all the easy liquidity on both sides is taken, leaving the market to chop around without a clear push. I would wait for stronger signals. So this example chart showed a played out range, with wicks from sweeps on both the ends. It's a real case where the market has used up its initial liquidity, leading to sideways chop. Practice drawing your lines here and tweak them as new sweeps show up. Ranges change over time. So here we got a sweep, and here we got a sweep. So for ranges, you always want to focus on the most isolated highs and lows. So for example, right here, this is not your range high, this is. And why? Because on the bigger time frames, it looks like this. This works because big players care about clear levels on higher time frames, like daily or weekly, over messy intraday wicks. Check those bigger charts to lock it in. If you want to identify a range and really make profit of it, take the range that fits the best, look for price actions that fits, and look for confluences around levels. Now let's talk about liquidity. Liquidity is all about stop losses piling up. Big players need these clusters to fill their huge orders without messing up the price. So for example, with a chart going up here, all the liquidity rests above it. And for example, for a chart going down here, all the liquidity rests above here. So again, people are shorting here and the stop loss rests above here. So all the liquidity is right here. And this kind of moves give more people the chance to entry and place a stop loss above here. And for example, right here, people longing put the stops below the liquidity. These people think they are safe. This happens because traders set these as protection, but the cluster becomes a target for bigger players. For example, right here, again, same move, liquidity, we go down and we sweep it one more time, the bigger players get in and we go into the right direction again. The retail has been stopped out, price moves into the right direction. For example, right here, again, liquidity, it gets swept, the bigger player take the orders and retail has been out and we go into the right direction again. I want to show you another example. Again, here lies liquidity, we move like this, you have a sweep of the highs and we go into the right direction. Another example, liquidity, sweeps of the low and we go into the right direction. Why do we make the sweep into the lows? It has to do with demand. So we make a dump and make a kilo, bounce back and make a series of lower highs, build up a shit ton of liquidity due to the upside. But we go down, right into demand, take out all of these orders and trap all late shorters at once by a short squeeze. Now let's talk about the OTE, or the optimal trade entry, using Fibonacci. The Fibonacci zone between 0.62 and 0.79 is where you want to entry. For example, right here, 0.62, 0.79. This zone is great because price often pulls back to these levels in trends, giving you a solid entry point. So here's an example. You want to draw from the swing low to the high when price pulls back to OTE. So again, 0.62, 0.79. Right here you want to entry. This works because Fibonacci levels match market order flow, making it a smart spot. Wait for the retest and be sure. Now let's talk about supply and demand. Sideways price action and then higher means demand. Sideways price action and then lower means supply. This forms because traders build up positions during the quiet time, setting up support or resistance when price comes back. Sideways, then a strong up move marks demand. When price returns, it often bounces. This happens because the longs who bought during the sideways period step up to defend their trades, pushing price up again. Look on higher time frames for a stronger signal. So again, sideways price action, strong up move, right into demand. So for example, right here, sideways price action, then a strong move down, marks supply. When price returns, it usually rejects, and this occurs because the shorts built up during the sideways price action again are gonna protect their positions. Watch for these rejections to time your moves. Now let's talk about breakers. When demand breaks down, it turns into resistance. But when supply breaks up, it turns into support. This shift happens because trap traders, long selling out or shorts covering, create new pressure, making those retests a great spot to jump in. Now let's talk about trading setups. Trading setups tie it all together, focusing on liquidity to guide your trades. This is where it gets real. Stick with me for some practical moves you can use. So now I just want to give some practical setups I will take any day. So for example, right here. Again, range high, range low, we make a sweep and we want to target the downside. Range low, range high, we make a sweep, we want to entry right here and we want to target the upside. Probably TP1 right here. Another setup. Range high, range low, we make a sweep. So all the liquidity, this is fast because the sweep grabs all the liquidity, pulling price to the other side. You can add something like OTE for extra confluence. Right here again the same. Range low, range high. We sweep the range low, we want to entry right here and we want to target the upside. You want to look for confluences. Stack the optimal trade entry with, for example, demand or supply. Sweep the low into the optimal trade entry and then go long, aiming for the high. Or for example, right here, we make a sweep, we want to entry right here and we want to go lower. This helps because lining up multiple factors lowers your risk and boosts your win chance. So for example, right here, you want to use demand with the ranges and the optimal trade entry using Fibonacci. So again, 0.62 level, 0.79 level. Here's where you want to entry and target those longs. Another example. Again, we have demand right here, range high, range low, and Fibonacci. So again, between those levels, you want to entry. Now to talk about trading the played out range. When both sides are swept, it gets choppy. Aim for the mid-range or small liquidity. This happens because all the easy liquidity is already gone, leaving the market to bounce around. Just wait for a breakout unless you see extra signals. At Fibonacci levels with a trend to guide you. Use wider stops for the chop. This helps because the Fibonacci levels gives you structure, even when it's messy, but you need room for noise. Be patient here. Now I want to give some ways to trade the mid-range and make it really practical. So right here, for example, we have a monthly low as our target. First we go trending up, trending down. The low has been made, your range low. The high has been made, your range high. The high got swept, so you want to look for sells because all the easy liquidity on the upside has already been taken. And once we break below the mid-range, here you want to entry because we are in a bearish territory and there's a fresh liquidity resting to the downside. Well, upside liquidity has already been taken. You want to look for shorts with a stop above range high. So a practical example. Right here we have a price rally. High made, but it's not swept yet. So your range high. The low has been made, range low. And here your range low gets swept. So what do you want to do? You want to close above the mid-range, retest it and start it continuing its up move. So you want to long with a stop below range low and target clean upside liquidity. And you can even target the previous month high as your liquidity target. Probability is all about stacking your odds. You want to look at the trend, is it up or down? Liquidity, but also support and resistance levels. The more you line up like a sweep at support in an uptrend, the better your shot. This cuts down guesswork. Practice stacking these to really win more. Thank you for watching. Now you can spot and trade ranges like a champ. Rewatch it to lock it in and practice on demo charts to get good. Like if you picked up something new and drop your favorite part in the comments. I love sweep. Hit subscribe for more and later it will show live trading on this so you understand it better and trade it perfectly. Join my free Discord via the link below to ask questions and check my plays. Keep learning, stay curious and let's grow together. Peace out.